The Tilray Brands Inc. stock, trading under the ticker TLRY on NASDAQ, is currently sitting at $1.6925 USD as of 1:01 p.m. Eastern Time on October 13, 2025, reflecting a 1.60% decline intraday. Now, if you're looking at that drop from the $1.72 close and thinking it's simply a retracement after the recent excitement, you're missing the crucial detail. The options market is flashing a major warning sign. Despite a seemingly solid recent earnings beat, which saw the stock spike on a surprise net income and record revenue, near-term options data is heavily skewed towards the downside, anticipating a significant correction. This suggests that sophisticated traders aren't buying the recent rally's narrative of fundamental strength, but are instead treating it as a speculative pump, tied primarily to unsubstantiated regulatory hope. This disparity between the headline earnings euphoria and the cold, hard hedging from professional traders is exactly where the risk and the opportunity lies for individual investors engaging in online investing. Many of us, utilizing platforms like Robinhood or performing self-investing through our individual brokerage accounts, tend to see the positive earnings report and the spike, and we assume the coast is clear. But the reality is that the underlying financial structure of Tilray and the competitive environment in the cannabis sector is telling a much more cautious story, one that sophisticated Interactive Brokers clients or those with Schwab Intelligent Portfolios would be factoring into their risk models. The general expectation surrounding Tilray Brands is a binary one. Either U.S. cannabis reform is enacted, sending all related stocks, including TLRY, soaring, or it isn't, and the stock remains tethered to the harsh realities of the Canadian and international cannabis markets. However, the contrarian take we need to consider is that even if the much-anticipated DEA Schedule III reclassification happens, which would remove the crushing 280E tax burden on U.S. cannabis operators and provide a massive tailwind, Tilray's ability to truly capitalize on that event is still an open question. Their business model, which we'll get into shortly, is a highly diversified global one, but their U.S. presence in the cannabis space is currently limited to non-THC products. Management talks about leveraging their existing infrastructure, but true U.S. THC market access would almost certainly require a major, expensive acquisition or a significant strategic shift, adding execution risk. This week's intraday movement, characterized by high volume and swift swings between $1.65 and $1.82, perfectly encapsulates this tension. The volatility is retail-driven hope wrestling with institutional caution. The recent earnings report for the first fiscal quarter of 2026, which reported a record net revenue of $210 million and a small net income of $1.5 million, was the primary catalyst for the stock's recent sharp move up. But the subsequent sell-off and the current downward pressure hint at a deeper reading of the numbers. Let's dissect the recent stock movement and the underlying financial reality. While the headline figures were exciting, a closer inspection reveals margin pressure that the options market is clearly reacting to. The company's gross margin dropped to 27% in the recent quarter, down 300 basis points year over year. Crucially, the cannabis gross margin fell to 36% from 40% in the prior year, a significant decline in what is supposed to be the core high-growth segment. This margin compression is a direct result of the intense, hyper-competitive pricing pressure in the Canadian recreational market, an environment Tilray must navigate daily. Furthermore, their widely touted diversification strategy into the beverage segment, which includes acquisitions like the former Anheuser-Busch InBev craft beer brands, showed flat revenue and declining margins, with the beverage gross margin falling to 38% from 41%. Management attributes this to SKU rationalization and integration under Project 420, but for a company whose main investment thesis rests on its diversified shield against cannabis volatility, a weakening in the shield itself is a major concern. The market is now selling off, not because they're bearish on cannabis long-term, but because they're concerned about Tilray's near-term profitability and ability to translate top-line growth into bottom-line shareholder value in the face of these margin headwinds. This is a common challenge for growth companies, whether it's a tech name like NVIDIA stock, dealing with supply chain constraints, or a consumer brand like Apple stock, managing component costs. But for a cannabis firm, the stakes are amplified by regulatory uncertainty. The high float nature of TLRY, coupled with relatively low institutional ownership, makes it particularly susceptible to these sharp, speculative swings, a characteristic often associated with so-called penny stocks, which is why the stock can soar 300% on news and then shed 15% in few trading sessions. It's a classic case of speculation outweighing fundamentals until the next earnings call forces a reckoning. Zooming out to the core business model, Tilray Brands positions itself as a global lifestyle and consumer packaged goods company, operating across 4 segments: cannabis, beverage, distribution, and wellness. Their Canadian cannabis segment is a leader in market share, and their international cannabis business, particularly in Germany and Portugal, is showing strong growth, with international cannabis revenue increasing by 19% in the last fiscal year. They have made significant strides in their global platform, securing a cultivation license under the new Germany cannabis law. The distribution segment, anchored by the CC Pharma business in Germany, offers a stable, non-cannabis revenue stream from pharmaceutical distribution, while the beverage segment provides a hedge against the slow-moving regulatory pace of the U.S. cannabis market, making Tilray one of the top craft brewers in the U.S. This diversified strategy is what sets Tilray apart from many of its pure-play competitors. For investors seeking a balanced approach within this volatile sector, the diversification theoretically reduces reliance on any single market. However, as noted with the recent earnings, acquisitions have padded the top line but have yet to consistently deliver on the bottom line, contributing to a substantial net loss of over $2.1 billion in the prior fiscal year, largely due to non-cash impairment charges. This highlights the double-edged sword of aggressive M&A. It buys scale, but it can also buy complexity and write-downs. When considering investment help or structuring your online investment portfolio, it's vital to look past the acquisition headlines and evaluate the true synergies and profitability of the integrated businesses, a principle equally applicable to complex financial mergers outside of the sector, such as those that impact Fidelity Investments, offerings, or strategies at SoFi Invest. Looking ahead, the future outlook for Tilray is inextricably linked to regulatory timelines, particularly in the U.S. and Europe. The most significant potential catalyst remains the DEA's potential move of cannabis to Schedule III under the Controlled Substances Act. This single administrative action would effectively remove the punishing 280E tax provision, dramatically boosting profitability for all cannabis companies operating in the U.S., and it could also facilitate greater access to traditional banking services, easing restrictions currently managed by companies using alternatives like certain Robinhood crypto features for parallel business activities. Estimates suggest that tax savings and valuation expansion under a Schedule III scenario could lead to a potential stock appreciation of over 400% from current levels, largely by allowing Tilray's existing U.S. hemp and wellness businesses to integrate more effectively into the national market. Outside the U.S., the gradual liberalization in Europe, spearheaded by Germany, represents another major opportunity. Tilray's established infrastructure in Portugal and Germany positions them well to become a dominant medical cannabis supplier in the expanding European market. However, the risks are substantial and often underestimated by investors focused solely on the upside. Regulatory delays or adverse tweaks to laws, such as Berlin tightening import channels for medical cannabis, could easily deflate the recent speculative enthusiasm. Furthermore, the existing issue of margin compression in the core cannabis and beverage segments needs to be reversed through operational efficiencies, which management is trying to achieve through Project 420. If these internal efficiency projects fail to materialize while the regulatory environment remains stagnant, the stock could easily return to its lower 52-week range of $0.35. Ultimately, Tilray remains a high beta stock, highly sensitive to sector-specific news, and prone to volatility far exceeding the broader market, even blue-chip names like Tesla stock. This demands a heightened level of risk management from individual investors who favor self-investing. The key takeaway remains the tension between the expectation of a regulatory windfall and the reality of grinding out operational profitability in a highly competitive, regulated, and fragmented global market. The market is pricing in a significant chance of a U.S. legislative tailwind, but the options activity and margin compression data suggest the market's smart money isn't yet convinced the company can execute regardless of the regulatory landscape. This stock's trajectory will be a masterclass in watching whether top-down policy drivers or bottom-up operational execution dictates long-term shareholder value. This is a situation where fundamental analysis needs to be the anchor, even when the speculative winds are trying to pull you away into the highly volatile waters of cannabis stock trading. We need to see sustained organic growth, not just growth via acquisitions, and definitive proof that their diversification acts as a true shield against margin erosion. The recent positive net income was a great headline, but the devil is always in the details of the gross margin and operational efficiency, which will ultimately determine if Tilray can indeed become a long-term compounder, moving it out of the highly speculative category and into a more respectable position in a balanced, intelligent portfolio.